Good afternoon, ladies and gentlemen. We're going to crack on and see if people can remove themselves from their coffees. Welcome to the Currencies panel, which is a topic we could cover a lot of ground on. I think we're going to concentrate on core currencies and try and cover a number of macro, market and structural issues. I'm absolutely delighted to have an distinguished panel, and from our pre-panel conversations, I'm confident that we will inform and perhaps even entertain you over the next 45 minutes. I'd like to start off by inviting panelists to introduce themselves and maybe just touch for a minute on what they think the most significant development has been in their perspective on the FX market and the currency market in the last 12 months. So what's sort of sticking out for them, or what's changed and they think is something that people need to consider, and then we can always dive into those topics obviously in much more detail later on. So maybe Eric, I could ask you to start.
Sure. Hi, my name is Eric Liu. I run the research team at Band Securities. We're a macro and strategy group based in Asia. I think the most interesting development, I guess most important development, has probably been the Fed rate hike. So, you know, I think many of us, including ourselves, were of the view that the hike would be a buy the rumor, sell the news event. And now that the event has come and gone, the other side of a lot of trades has kind of come and gone. So I think that's part of the reason why the JPY moves, the Euro moves are not as strong as previously expected, because you don't really have the US moving in the opposite direction anymore. At least people aren't pressing it in.
Very good.
My name is Maarten Spek. I work for ECR Research in the Netherlands. Well, besides the Fed rate hike, it was, I think, also important because it shows that major central banks are diverging in a major way. But I think the second important development lately is the refugee crisis. And I think it's important because it shows that the euro is very vulnerable. The EMU is not an optimal currency area. It requires a strong political will to keep the euro together. And as soon as that political will is evaporating or diminishing, the euro is in great danger, we think. And the refugee crisis shows that the political will to keep the euro together, or the EMU together at all costs, is diminishing. That's, we think, a big danger for the future of the euro.
Well, I'm Julian Jessup. I'm Chief Global Economist at Capital Economics. I wasn't actually originally intending to be on this panel, but I think somebody had dropped out, so I was eating biscuits in the green room and was dragged in at the last moment, very good for my waistline. In terms of themes, the first thing is I think the divergence in monetary policy trade is still a valid one. Obviously, the Fed has now raised rates, and yet the dollar has still fallen back. But I think that's because people have essentially revised away their expectations of further tightening from the Fed. So the Fed funds future has only got a quarter-point rate increase in between now and the end of the year, whereas we think the Fed will do a lot more than that. But two other themes worth mentioning. I think one will be the return of political risk. We've already touched on briefly the problems in Europe with the migrant crisis, but I also think the deeper economic and structural problems around the Eurozone haven't been resolved. We have the Brexit risk in the UK and elsewhere as well. But further afield from Europe, we have potential political risks in the US as well with the elections. And then the final theme is the movements in commodity prices and close correlation between some currencies and commodity prices, and of course precious metals as well, if I can include those as a currency for this purpose as well.
Lovely. Okay, well that sets us up very nicely, I think. And given the fact we're a cosy bunch this afternoon, I think we're going to make you participate as well. So just a couple of sentiment questions, just so we know what we're dealing with in the audience. I can already guess one individual's sentiment, but two questions. Has central bank policy influence on FX markets diminished or not? So if you think that central bank policy's influence on FX markets has diminished, please put your hand up now. And therefore, if you think it hasn't diminished, see if there's 1/3. So maybe someone can help us out on that. We got to get us started. Yeah.
Well, you may notice I'm one of those to start my hand up suggesting it hasn't diminished. It's still generally the case that if you want to explain the movements in at least any of the major currencies, the best way of doing so is plotting that currency against expected interest rate differentials between the two respective central banks. And that's held pretty well. Now, what has broken down is that sometimes official interest rates have moved in one direction and rate expectations have actually moved in another, so that may have confused the picture. So after the ECB last week, because of Draghi's signal that they weren't expecting to cut interest rates again, even though they cut interest rates that day, rate expectations actually rose during his press conference, and as a result the euro rose as well. So while the intention may have been to drive the euro down, the rhetoric actually pushed it the other way. I still think over the course of the next year or so, the markets will price in significantly more rate hikes in the US than they currently do, but probably also more easing in Europe and in Japan. And that, I think, will bring the divergence trade in policy terms back into play.
I'm probably of a somewhat different view. I think the rate differential trade has clearly been the major determinant of the euro trade in the last 18 months. But clearly that correlation shifts, and so if you look at what drove the US dollar versus euro in the pre-04, the yield differential was a big part of that as well. So I kind of think that the major story last year, if you look at positioning last year, everything was built around the US rate hike. So currency positions, equity positions, fixed income positions across the globe, we're all positioning for this single event. And I think now we've kind of had it happen, other forces like just clear sort of risk aversion, risk on, risk off are going to take over.
I think the influence of monetary policy on currencies per se hasn't changed, but what has changed is the ability of central banks, or the perceived ability of central banks to influence markets and the amount of ammunition they still have to stimulate growth and inflation. And in that respect, I think investors perceive the ability of central banks to influence markets as that it has diminished. So, as a consequence, the influence of central bank policy on currency markets has diminished as well.
So how does that work? I mean, we're not currency traders probably in this room, so how does that make me think differently this year about the way I allocate, about the way I look at my risk, and the way I behave with my positioning? Anyone?
When you have the opinion that central banks are capable to influence the market as they will, as they want, you just can invest in a risk-on, risk-off climate. So you think, well, if central banks are easing, that means a risk-on climate, and then you can pick the central bank which eases the most, and that currency will depreciate the most. But if you have the opinion that the influence of central banks on the markets have diminished, that's a whole different ballgame, because then the risks of financial markets are rising very fast, and so you can't invest anymore in a simple risk-on, risk-off sphere, which has been created by the central banks. And then you have also to take into account, have central bank policy increased asset prices artificially? What does that mean, or what does that mean for currencies movements? And if the ability of central banks has diminished to influence markets, that means that asset prices could have been inflated artificially, which has also a different risk factor for investing.
Yeah. Anyone on this?
I think the most interesting environment right now is in Japan, where the yen is highly overowned. The Nikkei is underowned both from a domestic standpoint and from a foreign investor standpoint. I mean, of all of the equity sectors that we look at, the Nikkei is by far the most underowned. And so if you're of this view that central banks are still driving currencies and the narrative in Japan is the central bank just isn't effective in driving the currency down, then the short trade works. But if it turns out that actually what drives the JPY is risk on, risk off, then it's a pretty interesting opportunity because of how sort of short everyone is in the equity market.
Yeah, I mean, I thought you weren't supposed to fight the Fed.
Well, I think the only theme that we have from the first 3 months of the year is fighting central banks.
Good question. Anyone on that topic? Yeah.
Yeah. So just briefly on the Japanese situation, obviously the concern over the last few years has been the fiscal position in Europe and Greece in particular. But as we all know, Japan's fiscal numbers are absolutely awful as well. The country's been able to get away with that for a number of years because of its relative wealth and strong net external position and so on. But I think there will be a choice over the next few years about how it deals with that mountain of debt. Some of the solutions that might be available to other countries are not available to Japan. So, for example, it can't grow its way out of trouble because we know about the adverse demographics. It can't really default on its debt because most of the debt is actually owned by Japanese institutions. So I think what it can really do is inflate its way out of debt. And I think the one way to get higher inflation is to drive your currency significantly lower, quite possibly by monetizing that debt and all the signals that would send. So our view is still that the yen will weaken significantly over the next few years. We have a forecast of $130 yen at the end of this year, 140 end of next year. But whatever the precise numbers, I still think the direction is clear, despite the short-term support the currency has received from safe haven demand.
So in that sort of perspective, we've got a pretty mixed environment at the moment. I think that sounds like quite a difficult investing climate, doesn't it? I mean, you're looking at no easy set of indicators to guide you through, correct?
I think what makes this current environment so difficult is you can't trust anymore that central banks have the ability to prevent a sustained risk-off phase. And that makes it more difficult to invest, more challenging.
But does the fundamental work matter again? I mean, we get off the risk on, risk off, and we can actually add value at a marginal level. Yeah, of course it's possible. But if you look at the investment world, excluding central banks, you have a picture of enormous debt levels around the world. You have potential growth levels which has declined due to graying or the so-called demographic effects, but also slowing productivity growth. So the growth potential of the world economy has declined. So that makes it a lot more difficult to service all the debt. In recent years, the companies and other debtors have been greatly helped by central banks lowering rates. So the debt servicing, the interest rate costs have declined tremendously. But now that possibility is not any because the rates are already at zero bound, and negative interest rates is also not only positive influence but also some negatives. It becomes much harder to service the current debt levels, and that makes the growth environment much more challenging and also more difficult to invest. So the central banks might not matter, but the macro matters.
The macro, much even more.
Yeah, I'd agree. I think that's probably one one of the more promising, optimistic views that we might have over the next couple of years, which is, at least in the US, as you get off the zero bound, policy rates are going to be much more of a function of macroeconomics, which, you know, in the heyday of the Taylor rule, the 80s and the 90s they were, and less about individual central banker personalities or, you know, what Janet Yellen's kind of PhD thesis leaned towards. You know, so I think we are entering now a world where macro matters more.
Okay, so we can just carry on looking at payrolls, etc.
Yeah, we hope.
Guessing unemployment. So, okay, so at this stage, I just want to touch briefly on sort of geopolitical concerns and things that you think are part of the sort of tail risks out there. We have had at least one request from people that were attending today to make sure we didn't forget Brexit. I mean, I was wondering whether Brexit was the Donald Trump of issues for Europe, in the sense that it's fun to read about, but you don't have to price it in. Can anyone give us their sort of base case, what their advice is to concerned clients on Brexit?
Right, well obviously at Cap Economics we don't have a house view on the merits or otherwise of Brexit. Were you to read anything by Roger Bootle, you might get an alternative impression of that. We've actually done quite a bit of work on this, particularly in the context of cable. We've made an estimate of where we think cable should be on the basis of interest rate differentials and compared that to where it actually is. Roughly speaking, we think on the basis of expected interest rate differentials, cable should be at around about 150. In practice, it's around about 140. And we attribute that 10 big figure difference essentially to a Brexit uncertainty premium or discount, depending which way you look at it. And of course, at the moment, the markets are not expecting Brexit to happen. So if it did look like Brexit was going to happen, or indeed it did happen, then you'd expect that premium significantly to increase. You also have to ask what the counterfactual is, because as it happens, I think sterling will weaken against the dollar anyway, regardless of Brexit, because of interest rate differentials again, with the Fed tightening more aggressive than people anticipate, and the Bank of England remaining on extended hold. So we're basically telling clients that there may well be two scenarios, one in which we stay in, the EU, in which I think the pound will fall to 130 against the dollar, and another in which we leave, in which case I think the pound will fall to 120 against the dollar. Now, obviously those are numbers, they're ballpark figures, but I think you can see either way, in either scenario, we think that sterling is going to fall.
Yeah, we think that British people will decide against Brexit because it will be too costly for them to exit. So we hope and we think they make a choice given by economic reasons. So given that we think that Brexit will be avoided, we still think that the cable will decline further towards 130, 135. And that's because we expect a stronger dollar. However, euro pound could decline towards 70, as we expect a weaker euro.
I think I don't have any particular fundamental view. If we just look at the differential in positioning, at least the short positioning in sterling is suggesting that the pricing in some degree of that, and it might be 10 points or whatever. But if you look at the differential between short positioning in sterling versus euro, it's almost as wide as it's ever been. So kind of a long euro short sterling, or sorry, a long sterling short euro kind of trade could be an interesting way to play it.
Very good. Okay, so maybe if we move on a little bit and talk about sort of some specific outlooks. I mean, you've given us some interesting guidance on some pairs there. I just wanted to ask the audience at this stage, just to get a feeling for your sentiment in this room. Will the euro dollar drop below parity this year? Hands up if yes. I'm surprised. So, okay, and then below 105? What do you think about that? Do you think it's sort of more parities than I thought? Anyone want to weigh in on that? What do you guys think?
Yeah, well, again, my hand went up. I think there are a number of stories here. I mean, the first is the simplest one, interest rate differentials. There's also the broader economic outlook. Now, of course, the two are related, but we do think that economic growth in the Eurozone will be slower this year than last year. Last year, the Eurozone clearly benefited from the fall in the euro and the big drop in oil prices that was clearly a bigger positive for Europe than it was for the US. So that provided some temporary support to growth, but we're already seeing signs of weakness coming through. On top of that, you've got the political overlay, not only the problems within the European Union, the Eurozone, the refugee problem, but if the UK were to vote to leave, then I think that puts the whole European project under threat. So even in the absence of any changes in immediate interest rate or growth prospects, I think the political risk will weigh on the euro again. That said, I don't see it collapsing. I mean, in many ways, Europe is quite attractive, precisely because we are likely to get additional monetary stimulus, and I think European equities will outperform those in the US. The region is running a current account surplus, not necessarily for a good reason. It's running that because its imports are so weak, but even so, it's in a fairly comfortable external position. So I wouldn't expect the euro to collapse, but I still think the risk is skewed towards weakness.
We also think that euro-dollar will drop below parity, probably towards 90 or 0.9. And that's because of two reasons. The first one is that we think the Fed will hike rates further, and that's due to the diminishing output gap the US economy has. We still think that the US economy will continue to grow, given favorable oil prices, rising wages, and that still supports the domestic economy. And given the diminishing output gap, we also think that inflation expectations will go up, and that gives the Fed all the reason to hike rates. Not by that much, because it will also contribute to a stronger dollar, especially as US dollar debt outside the US has increased significantly. We think rising US interest rates plus the effect of a stronger dollar will give companies and companies outside the US a bigger incentive to repay their dollar debt earlier, and that's almost equal to a short squeeze on the short squeeze on the dollar. And we also think that the euro will go down because of political reasons. And if you look at the output gap in Europe, it's much bigger. So even if European growth continues, the output gap will close rather slowly. So the ECB has all the reason to keep rates low as they are now. So that means a strong incentive to sell your euros and buy dollars.
I mean, I think we're kind of of the view that stays kind of range bound within 105 and 115. And the interesting thing is when you think about the two things that we've learned in the last 2 or 3 months. One is that the Bank of Japan is effectively putting a cap on U.S. rates, right? Because the negative rate forces pension funds out of Japan into the U.S. So they're putting a cap on U.S. yield at the same time that Mario Draghi is putting a floor on European yields. So, while there might be an opportunity for differentials to increase, I think there probably is sort of a limit to that.
So the competitive devaluation, conspiracy theories move to where?
Well, I knew that the currency wars idea would come up at some point. It's something I'm actually very sceptical about. I mean, the idea seems to be that countries are primarily setting monetary policy in order to achieve a certain outcome for the exchange rate. Now, while it's true that cutting interest rates or any monetary policy loosening will tend to weaken your exchange rate, that's only one of a number of channels by which the policy operates. Now, the importance of different channels varies from country to country, but there are many other ways that looser monetary policy can operate. And you have to ask yourself also, well, what would you expect central banks to do as an alternative? If they're not allowed to use monetary policy to weaken their currency, but they still want to cut interest rates, are they supposed to cut interest rates and intervene to support their currency? I'm not sure what the counterfactual is. So I don't really buy this currency wars idea. There's no doubt that it has worked in favour of weaker economies like the Eurozone and Japan that have seen their currencies weaken, and it's worked against the US. But arguably that's a desirable thing. The strength of the dollar has helped to redistribute demand away from those parts of the world that need it the least in relative terms, namely the US, which is doing relatively well, towards those parts of the world that do benefit from it. I appreciate there are some additional risks, in particular the amount of emerging market debt, for example, that's denominated in dollars. But as a proportion, that figure is actually pretty low. And emerging market debts generally, as a percentage of GDP, are lower than those in advanced economies. So that is a negative of dollar strength, but I don't think it's an overwhelming.
All the bad stuff at the beginning of the euro prevents a lot of people at the end that was going to kill us all.
Yes, I get it's like a sense of perspective here. People are saying that, for example, Chinese debt is 250% of Chinese GDP. Well, that actually is a ratio that most advanced economies would kill for. I think it only places China about number 20 in the list of indebted economies as a percentage of GDP. Remember also that, of course, the Chinese economy is likely to continue to grow more strongly than those in the developed world, so it's easier to support given level of debt. There's more that the Chinese policymakers can do in terms of loosening both fiscal and monetary policy if required. And as those of you who were in the first session this morning may have heard me say, Chinese policymakers have a lot more levers than policymakers in the West do. So whereas the Bank of England governor can't order Lloyds or Barclays to lend, People's Bank of China government most definitely can, and has some very effective tools to use if they don't. So the chances of that sort of liquidity crunch weighing down on the Chinese economy are a lot less than it would be in a more liberalised Western economy.
Now, one note about competitive or currency wars or competitive devaluations. In a world economy which is plagued by deflationary forces, excess capacity in Asia, slowing growth worldwide, one of the few ways to grow your economy using monetary policy, especially when the banking sector is stuck because tighter regulations prevent them from expanding their balance sheet in a major way. Then the only way to stimulate your economy is by devaluing or depreciating your currency. But the side effect of that is that you're in effect exporting deflation to other countries. So then they are forced to follow your example. You don't want to start a currency war, but in the end, you end up with an unintended currency war.
Just a little bit wary of that for a couple of reasons. We take Japan as the prime example. It's often said that the weakness of the yen has given Japanese companies a huge competitive advantage, implying that they've used that opportunity to cut prices in dollar terms, for example. In fact, by and large, they haven't. What they've done instead is kept their prices the same in foreign currency terms and benefited instead from those revenues being worth more when they're translated back into the domestic currency. So the Japanese economy has benefited in that way, but not necessarily to the major disadvantage of any of the competitors.
I think however you kind of land on the currency war conspiracy, what's clear is that for the last 3 or 4 years, running that sort of strategy, I guess, as a central bank had very little cost, right? Because inflation was so low, you just keep printing. So even if inflation doesn't come back, there is now increasingly a cost to lowering rates below negative, right? So Governor Kuroda is now being dragged in front of Congress every week, and you see the impact that Mario Draghi's comments had. So I think there is now much more of an explicit cost to pursuing that kind of strategy. So one way or another, you have to assume that's going to die down a little bit.
Another remark. If you look, for example, at Canada, over the past few years, they had the help of a depreciating currency, and now you see their exports without commodities growing. So their economy is definitely helped by a weaker currency, and also by stronger US demand, of course. But there's another way how you could stimulate your economy by a so-called currency war, if it is unintended or intended. That's if you loosen your monetary policy, your currency is depreciating, then your asset markets or your asset prices tend to rise more rapidly, and that's also, of course, a very positive thing for your economy, and it also attracts foreign capital to your economy. And that's although central banks won't say that's their aim, I think it could help combating deflationary forces.
And in Europe, we need all the help we can get.
Exactly.
So at this stage, perhaps talk about, we can address slightly FX extrapolations into other asset classes, into equity market positions, or because I don't think we're going to talk about pure currency trading here. If you're a traditional long-only equity guy and you just want to stay on the right side of things and make sure that your trade ideas aren't completely wiped out by the FX situation, and you want to understand whether to hedge or not to hedge on particular ideas and situations. Is there any guidance? What are you guys telling clients about the sort of extrapolations of the FX outlook to your sort of traditional allocations?
Yeah. Well, first of all, a lot of the relationships that have held well over the last few years still hold good. So you can plot the Nikkei, for example, against the dollar-yen exchange rate, and that's an extremely good fit. But there are some new relationships that are emerging that I think are also very interesting. For example, if you plot the month-on-month change of the US equity market against the month-on-month change of the renminbi, China's currency, that is now an extremely close fit as well. So global markets, including US equities, are very closely tracking what is happening to the renminbi, partly because of the signalling value, what that might be telling you about the strength or otherwise of the Chinese economy, partly because of the fear that if China does allow the renminbi to fall significantly, then that will be the next big leg up in the dollar on a trade-weighted basis. So there's some new relationships that are starting to get quite interesting to look at as well, and that's what we've been banging on to our clients about.
Yeah, I think, I talked about this earlier. Japan's interesting because precisely because this relationship between the currency market and the equity market still exists. And so if there's a lot of long interest remaining in Japan, everyone's long Japan overweight, the JPY, and everyone's short the equity market, you only need one of the two to reverse to get a strong equity market. So either the currency reverses or you get some sort of catalyst in the equity market. So that's a fairly interesting trade. And then in the US, we continue to say that if we continue to see this sort of the weakness in the trade weighted dollar, which is entirely dependent on oil, a really under-owned cyclical sector like industrials could be fairly interesting.
Yeah, we now in this current low yield environment, we think especially bond investors are helped if they invest in foreign bonds more unhedged, so that you include a currency view on your bond positions. Because in the last few years, bond position was still rewarding because of rising bond prices. However, as a lot of long-term interest rates reached the 0% or almost or close to that, the latitude or the future profit you can make from buying bonds cash is diminishing, we think. So currency changes will contribute a much bigger part on your bond exposure and your bond yield.
You're going to have to read both pieces of research to feel good about that. That sounds like a lot of work to me, but I do see the common sense there. In terms of, I think we've got 5 minutes, so at this stage, just open it up. Does anyone have any questions that they'd like to ask our high conviction esteemed panel. So I think first one up here and then go to Simon.
One of the themes that was highlighted at the beginning was the relationship and co-movement between currencies and
So the relationship between what, sir?
commodity prices
Yeah.
and currencies. So I guess this is a natural segue to the next session. So could you say a little bit more about the prospect for some of the key commodity-rich currencies, say the loonie, the BRL, and the $A?
Yeah. Well, Sonny mentioned the idea of high conviction trades, and I'm speaking quite confidently about the outlook for the dollar against the euro and the yen. I must admit I'm less confident about the outlook for the dollar against some of the major commodity currencies, because I think there are two strong forces, each likely to be pulling in opposite directions. So on the one hand, which I know economists are not allowed to say, but I just have, on the one hand I think commodity prices will recover further. We'll be talking more about that in the next session, so that should be a positive. On the other hand, I think the monetary policy story will remain negative for many of those currencies, particularly the Aussie and the Kiwi dollar. New Zealand surprised many people, though not us, by cutting rates at its last meeting. We think New Zealand will cut further. We think Australia will cut further. So there's sort of a two-way effect there. The view of our specialists in those areas is that the downward pressures on those currencies will prevail. So you'll still get further weakness in the Aussie and the Kiwi dollars. I'm slightly less convinced of that, if I'm allowed to share some differences of opinion there. As for things like the Brazilian real, well, one of the things we have seen, of course, so far this year is that those things that fell the most last year have come into favour this year. So it's a classic case of rising tide lifting all boats, and even things with terrible fundamentals like iron ore have benefited from at least short-lived rallies so far this year. And it may well be that if global sentiment recovers, even the Brazilian real, dreadful fundamentals there, can have some good periods. But I would still be wary of currencies like that, because the domestic situation is still so dire that the last thing that they need is a rapid rebound in their currencies on top of all the domestic problems that they've got. So on balance, I would still be cautious of commodity currencies in general, though I think some will clearly benefit from a rebound in the commodity prices themselves.
Yeah, we are fairly positive about the Canadian and the Australian dollar, because they have showed now it's quite remarkable how good their economy is performing, given the strong decline in commodity prices. So they have shown that they have a much more diversified economy than many investors believed. And we think both currencies are undervalued, and they've a lot more potential to increase. However, in the short term, we expect more speculation on Fed rate hikes, and that will weaken both currencies. But that will be a good entry point, we think.
More on that one, we'll move on to the next question. Yeah, okay. I was just saying, I assume Russia didn't do so well in that one, but having had to do the diversify of the Russian economy panel for year after year in my previous life. So, Simon, I think you had a question.
Sorry, just a follow-up to Eric on the Japanese yen discussion. Can you clarify, you're saying that Nikkei is under-owned and the yen is over-owned?
That's right. So, so dollar yen is under-owned. So people think the yen's going to appreciate. Amongst the currency pairs that we look at, the yen has the strongest appreciation bets going forward. At the same time, as we mentioned, we look at Nikkei positioning both from a local investor standpoint as well as foreign, and both of them are extremely, extremely under-owned at this moment.
Can I ask a quick question about non-commodity emerging market currencies? Because it seems to me that the local currency yields there are really quite exciting. The only reason for not being in that trade is that you think the currency might go down some more, so it's a bit of a sort of chicken and egg situation. Have we actually seen the bottom of emerging market currencies? Will people go hunting for yield in India and Indonesia and places like that?
Well, obviously, emerging markets are a huge very diverse group. If I could focus on those emerging market countries that are, by and large, net commodity consumers, then I think the answer to your question is probably yes, those have bottomed out. They will benefit, I think, from an extended period of relatively low commodity prices, while at the same time, unless you believe that the US central banks are going to go completely crazy and take rates to the moon, which even I don't believe, and on my forecast the US won't be hawkish, you're still going to get very sizable yield pickup on those countries. So improvement in sentiment towards emerging markets in general, non-commodity economies, I think, should do pretty well. Amongst the commodity currencies, I say it's a harder call because I still think they'll be suffering from the previous sharp falls in commodity prices for some time, and they will, I think, be keeping rates lower for longer. So there are risks there. But in general, yeah, I think emerging market currencies have bottomed out. The renminbi, of course, is perhaps one of the most interesting ones. I don't for a moment buy this idea that the Chinese authorities are looking for a big devaluation of the renminbi. Look what they've actually been doing. They've been maintaining broad stability on a trade-weighted basis, which is exactly what I think most people would advise them to do. So the renminbi, I think, will be broadly stable on a trade-weighted basis, and what that means for the exchange rate against the dollar will depend on what the dollar itself does against other majors and against other major emerging market currencies.
Now we think that the renminbi is poised for a big decline this year. And that's because we think that's one of the few options the Chinese have to stimulate their economy sufficiently to avoid another big surge in debt. And I think their fear of growing debt even larger as a percentage of GDP is bigger than their fear of consequences of a large devaluation of the renminbi.
Yeah, the only thing I'll quickly add about the RMB is, so we're not seeing a big depreciation either, just because that would sort of open the floodgates, is that when you think about the trade-weighted dollar, 30% of the trade-weighted dollar is the commodity block, and another 30% is, we'll call it the China block, which is RMB, Korean won, Taiwan dollar. And so the RMB and the PBOC is always going to move in a I guess, a pro-cyclical fashion with oil. So if oil strengthens and commodity currencies strengthen versus the dollar, the RMB will then strengthen versus the dollar as well, because they will have that room on a trade-weighted basis. So you now have 60% of the trade-weighted dollar that's purely a function of oil, which means, you know, if you can call that, then you got a pretty good idea where the dollar's going to go.
Yeah, very good. Okay. Well, I think on that note, I shall thank you for your attention and thank the panel for their opinions and diverse calls on various things. Thank you very much.